Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's September 12th. And I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. You know, it's amazing how hurricanes get better ratings than like the Super Bowl. I mean, everyone is glued to their televisions. But it's the Weather Channel, CNN, nonstop coverage. Everything stops. No more politics, no more BS. Just everyone just talking about the hurricane, watching it, even if you're not impacted by it. People in California are watching it, getting emails. You know, if I'm okay, we're okay. It's not going to hit us in Florida, northern Florida, get the Carolinas. And you have Hurricane Florence, right? It's approaching. They have people reporting right on the beaches. They put these guys in like the worst areas. It's crazy. Wind, debris flying all over the place. So people just love that stuff. They love it. And now I've been living in Florida for, 8 years. It's pretty crazy. I think it's that long. 8 years. I'm more into it now than ever. And know everything there is to know about hurricanes because we need to. I mean, Florida is ground zero for hurricanes. In the 8 years I've lived here, again, it's in northern Florida, we got nailed with 2 hurricanes thus far. The first one is 2016, Hurricane Matthew. Pretty scary. It's projected to directly hit northern Florida. And my family evacuated 2-3 days prior, and I stayed here. I said, just wait. And with 1 day to go, it was going to hit our town. Like our town was being broadcast all over the nation saying this is like where it's going to hit. And we live kind of on the beach, 4 blocks away, and there's a bridge there. And they actually said, look, if you decide to stay, you're on your own. We're not coming to save you. They actually said that. The mayor said that. Because we're not, and it makes sense when you think about it, because we're not going to risk anyone and come over that bridge when a lot of people get flooded, and we told you to evacuate. That was enough for me because, again, 24 hours left. It was going to nail us. I left, and we got really lucky. In the last 15 hours, the storm moved north, mostly stayed offshore. And lucky it wasn't that much damage. We lost electricity for like 2-3 days, debris every place, but no damage to our house. But it did drift east. Again, we got very, very lucky. We had Irma last year, which destroyed Puerto Rico. I mean, the Keys was insane. South Florida got nailed. And our family didn't need to evacuate since, once the storm hits land, it dies down. The time it hit northern Florida, it was, wind speeds weren't that great. A lot less compared to where, it hit Puerto Rico and South Florida. I think more than 8 people died from Irma, caused more than $50 billion in damage in the U.S. But now a few things. Because Florence, with 140 mile per hour wind speeds, okay, it's about to hit the Carolinas. That story is scary enough. But the media, they love pouring it on. They love pouring it on. And not just the BS news organizations trying to get page views, whatever. It was just like Reuters, Zero Hedge, I guess you could expect, right? They always love reporting end of the world stuff. But they're reporting and have headlines how U.S. nuclear power plants are preparing for Hurricane Florence. And there are like a half dozen nuclear plants that are in the path of the hurricane. And just to put this in perspective, okay, I know 140 mile per hour, it's a major hurricane classified category 4. Again, I know everything about hurricanes living in Florida, and I'll explain how crazy this is in a minute. But Fukushima, that nuclear plant that was damaged, that happened after a 9.1 magnitude earthquake that caused a tsunami that had 50 to 100 foot wave surges that hit that plant anywhere from 400 to 500 miles per hour. Okay, to put that in perspective, that's around the same speed of a Boeing 787 Dreamliner. Okay, that almost never, ever happens. Okay, this is totally different. I know the media sites, you need page views, and at times it's scare the hell out of people or be, and I'm going to say it, I don't like cursing, be assholes. I get it. You need to make your money, fine. But this is the real deal. And Florence is a major hurricane that's going to wipe out neighborhoods and cause deaths. And do you really need to pour it on even more with stories mentioning the word nuclear or radiation? Is it possible you guys just do the right thing for once? Maybe publish stories that educate these people in the impact zone? Or maybe provide a hurricane survival guide? Just once. If you could do that just once. That's all I ask, just once. I know it's a long shot, but come on. You guys got to do better than that. With that said, living in Florida, you learn a lot about the hurricanes, especially if you have families. And reading stuff about hurricanes and being in one are two totally different things. And if you want to put that in market perspective, it's like you being a retiree with your 401k and you're not working during the credit crisis compared to some young kid who has a model portfolio and sees the market crash. Okay, he's going to be like, wow, that's pretty crazy. When the 70-year-old person who's retired is like, am I going to have to work? How am I going to? I don't understand. What am I going to? You're living through those emotions because your money is invested. Your home price is crashing. You don't have your portfolios is down 50%. And, based on the statistics, which as a retiree, it's only going to last, it's supposed to last 30 years. Now it's going to last 10. Yeah, that's scary. It's a total different event when you're in one compared to just reading how bad it is. And I've been in one. And I posted a video on Twitter yesterday. And this is from last year when Hurricane Irma was approaching. It was about 6 hours away. The wind speed, again, it was dying down. It was about 35, 40 miles per hour at the time. And this video, 35 seconds long, you could barely hear me. I could barely hold my phone. Florence, Hurricane Florence, as of today, right, doing this Wednesday, it's going to hit the Carolinas at wind speeds at more than 100 miles per hour faster than that, faster than 35, 40 mile an hour that you see in that video where you can't even hear me talking and the wind, my hat's almost blowing off, my windbreaker's like blowing. It's insane when you're in it, guys. It's crazy. So everyone living there, you need to take it seriously. And during Irma, I stood on the dunes at the beach, and before it was approaching, there were telephone poles in the ocean, and the water was so rough, it was throwing them around like they were leaves, telephone poles. And foam from the top of the waves was flying into my windbreaker jacket, nailing me. And they were filled with sand, again, hitting my jacket. When I got back to my car, I had nicks all over from how hard the sand was hitting me. With little, blood things, little nicks and stuff like that. That's 35, 40 mile wind. And when wind picked up, I think we had the max of 65, 70 mile per hour. That was maximum. And we had damage every place. We had electricity out for 4 days, generator. Our house wasn't down, debris every place and every street. Everybody had to clean up. Again, it was pretty crazy. Some people had damage to their houses, to their stores. There was floods. Remember, Florence, expect to hit land at 130 to 140 mile per hour wind speeds. Tides are also important. The difference between low tide and high tide, guys. Basically, the difference between whether your house is going to get destroyed or not. During Irma, at its max peak, it was a Category 1 storm. The 8 hours it hit us the hardest, we had low tide. I mean, I was on those dunes. The storm surge was up to the dunes, and you could see the big waves out there. I wish I could explain it. I wish I could see it. I tried to take as many videos as I can. I was playing live from the storm last year. If it was high tide instead of low tide, tons of houses on the coast would have been flooded, wiped out. I mean, not mine. I live about 4 blocks away from the ocean, much higher ground, but a lot of my friends in the area live on the ocean. They would have got wiped out simply based on the timing of the storm hitting us. I mean, put in perspective, in New York, when Sandy hit in 2012, it was high tide. The storm surge flooded major areas. Even New York City, downtown, got flooded. You had $60 billion in damages. And Sandy, top wind speeds, around 70 miles per hour. Florence tracking at 140 miles per hour right now with nothing in its way to slow it down before it reaches land. When it reaches land, it slows down, but it's going to be too late. There are over 1 million people ordered to evacuate. I have a lot of friends in the Carolinas. Could go north of that. Don't be brave, especially if you have families. I'm telling you that because I'm exactly like that. I'm stubborn like that. The guy doesn't really worry about everything. The guy who usually will stay when a hurricane's about to hit my town. After seeing these hurricanes firsthand and being in one that's half as bad, less than half as bad as this one, be smart. Evacuate. It's only a house. You should have insurance on. There's only one you. You don't get a do-over if you die. If you're really that stubborn, right? Like most men are between the ages of 40 and 70, we are. It's not about you. Like, think about your families, the people that care about you, because they're going to be hurting if anything happens to you. Especially since you got hurt doing something you could have easily avoided if you listened to the authorities and evacuated. And more important, if you ignore the warning signs, stay in your home, and you don't make it out, if you're a lifetime subscriber, that subscription ends. You're done, pal. Sorry, no refunds. Remember, our lifetime offers are based on your life, not mine. I know you're really going to miss getting my research more than anything, right? That's the most important thing. But in all seriousness, look, just be safe. Until you're actually in a hurricane, I mean, guys, you have no idea how powerful they are. It's insane. Just look at the video I posted on Twitter. It's not a way to get more Twitter followers. I really don't care about that. It's a simple 35-second interview. But my hat is barely on. I could barely hold the phone. You could barely hear me speaking due to the wind gusts. And just keep in mind, that's 35 miles per hour. Again, Florence wind speeds minimum of 130, probably 140 that are going to hit directly. And it's going to happen over the next couple days. So good luck, guys. And please, please, please be safe. Okay, let's move on. I have a great guest today, someone I interviewed only once on this podcast. That was a little while ago. Got great feedback from you, so I'm bringing him back on. And this person is Chris Versace. Love that name. And Chris is the co-founder, chief investment officer of Tematica Research. He has over 20 years experience in the investment industry. I know this, unfortunately, because I worked with him a while ago. We used to work at TheStreet.com together more than 10 years ago, and it was great because we caught up when I was on New York Stock Exchange last year when I was ringing the bell with Frank Holmes and his company, Grow, which is awesome. And Chris was on site. He was actually on TV, and he said, "Hey, Frank, what's going on?" And we just caught up. It came to the podcast, and now, pretty cool. Awesome. Got to get myself back to New York a little bit and back on the New York Stock Exchange sometimes. But Chris also hosts a podcast called Cocktail Investing with Noah Hawkins, who, by the way, I'm not going to promote this, but you got to hear this. Because I created the All-Star Portfolio where we take one pick from stock experts I interview. Sometimes I'll get them during the interview. I talk to these people before, after, and they'll come up with great picks. We always share ideas, and I'm putting them all in a portfolio called the All-Star Portfolio, and we track them. It's a great service. Lenore was on. It was June 27, not that long, less than 2 months ago. Her pick, Universal Display, OLED is a symbol. It's up 60% since beyond. What is it? 60% in a little over 2 months. 60%. One of the best performing stocks in the All-Star Portfolio. Which, by the way, again, All-Star Portfolio, you get these picks from the world's leading stock pickers, the people I interview, for $1 at allstarportfolio.com. That's all it is for 14 days. You don't like it, you can throw it out. If you like it, it's $9.99 a month. But 60%. Anyway, Versace has his hands full trying to compete with this partner, Lenore. It's going to be awesome because Chris is seriously, he's a great analyst. And one where we can go anywhere because it covers almost every sector, most stocks, just like a market junkie. He is a market junkie, just like me. We're going to share a lot of ideas with you. So be sure to get your pen and paper handy. An awesome interview. Then in my educational segment, I'm going to recommend a sector, or should I say industry? Not really a sector, but an industry. It's only a handful of stocks in the industry that has huge upside potential. Okay, it's an industry that's going to surprise the hell out of you when I mention it because it's one I never recommended before. And they're going to think I'm crazy because many people in this industry is dying a slow death. But remember, we heard the same thing about oil in mid-2007. It was around $4 a barrel. It's going to $10. Yeah, okay. So 70, 65, 70 today. The same thing about big box retailers late last year, right? They're dead. They're dying. It's over. Now, what? One of the top performing sectors in 2018. Everybody loves the retailers all of a sudden, right? It's going to be an awesome segment I'm titling, Don't Believe Everything You Read. So I'm going to share this industry and a few stocks I like in it in my educational segment in a few. And speaking of stock picks, let's get to my interview with the one and only Chris Versace. Chris Versace, thanks so much for joining us again on Wall Street Unplugged.
Oh, Frank, thanks for having me. And it's not only great to be with you and again and your listeners, but it's always fun to have the tables turn because usually I'm doing what you do.
On what? Yeah, your podcast, Cocktail Investing, right? I mean, it's great that you're in it. Feel free. No, listen, you take the time to come to the podcast. We could plug your podcast. It's very good.
I know. I was hoping to do that a little later. But yes, I appreciate that. That's the Cocktail Investing podcast where we, quote unquote, distill all the everyday noise into clear investing signals. And you've had my partner on, Lenore Hawkins, who's our chief macro strategist. And she's tops.
We're going to get to that in a minute because, it's going to be a really cool mini segment inside of this when I bring that up. But first, I want to talk to you about the markets in general, right? I mean, I'm sure you're getting emails. I get emails. People are worried and, they're like, okay, it's the longest bull market ever now, depending on what stats you look at. But most people, it's one of the longest bull markets ever, if not the longest. And everyone's like, okay, it's going to come down. Well, you look at valuations. Well, not crazy high. Again, a lot of that's from tax reforms. It's 16 times forward earnings. We're looking at a market that's earnings are growing, right? Double digits, more than double digits. Economic indicators look great, but we also saw the same thing in 2006 into 2007, and we know what happens today. So what are you telling your clients now? You finding great ideas? Is it you're looking at macro things like inflation, which I think is a bigger risk now than it has been probably in the last 15 years, I think is not really talking about. Is it the Fed you look at, interest rates? What are some of the things that let's talk about the macro first.
How much time we have for this answer?
I know, it's cool. Go ahead.
So, I mean, there's a couple things you touched in there. And one is the direction of the market. Look, the economy is growing. We've gotten a bunch of different stats over the last couple of weeks for the August data. So we're getting, now 2/3 of the current quarter's data, really. And so far, so good. We're still in expansion mode. I, too, am seeing what you're seeing on the inflation front. We look at the prices paid numbers, ISM manufacturing, ISM services. Even today, as we're taping this, we got the August PMI data, which, the talking heads are all like, oh, the first decline in 1.5 years. But I think you and I and your listeners, Frank, know that that's total BS, because if you look at the core over the 12-month, you're up something like 2.9%. So, inflation is definitely baked into the system. And I do have some concerns about that. One is, does the Fed begin to feel that they might be behind the curve, which means all of a sudden, again, as we're taping this, we've got likely 2 rate hikes ahead of us in 2018 and then a couple more in 2019. Does Powell and the Fed begin to think that, we're behind the curve and we've got to ratchet up the number of rate hikes? And the reason I get a little worried about that is, one, we've already seen the housing market really start to slow down in terms of mortgage applications. And we know that there are issues inherent in that market where, because of shortage constraints, prices have gone, and this is a technical term, bonkers, such that, the number of people who can afford that down payment, who are straddled with credit card debt, auto loan debt, student debt, is not all that robust. And the cost on those houses are going to get even higher as interest rates tick higher. But also for the consumer, as interest rates tick higher, their debt service cost will grow as well. And my concern is, yes, we had a good August employment report when it came to wages, but as you know, Frank, 1 month does not a trend make. So I'm a little concerned about the consumer as we go into the back half of the year, more so in 2019, to be honest.
Yeah, and it's funny because in 2017, late 2017, right, we saw that retailers, big box, they're in trouble, they're dead. Now it's like one of the flavors of the month. Target came out and said, it's one of the best environments for consumers that they've seen. And now the same people who are calling for the death of big box are like, you got to buy the sector now when it's up a lot. Yeah, it's kind of, and that because you see these people, you're on the stock exchange, you're all over TV and stuff like that. But it's just kind of funny where, how does that translate into individual investor, right? Because we're programmed, everybody's programmed to really buy when you're excited and buy high and almost sell low when you're panicking. And of course, we've done this and we've made mistakes before doing it for 20 years each. How do we translate that message or tell the individual subscribers, look, I know you're seeing a lot of great data, but it could be a really good time to take some profits?
Yeah. Okay. So there's a couple things in there. The first one, let me just get right out of the way. We at Tematica do not believe in sectors. Okay. Having been a Wall Street equity analyst, much like yourself, and having done this for a long time, the notion of, hey, pick the best sector and buy that may not give you the most optimal exposure that you want to what's really going on in the world, which is why we, again, look at the world thematically, hence Tematica. And we're looking at those shifting landscapes of demographics, economics, technology, psychographics, and a few other things. So we're always looking for the change, right? If you go back to, I don't know what degree of math you took, but I and Lenore Hawkins, sad for you, Frank, we were both double majors, math and economics. So we talk about the rate of change or the impact of change. And when we look at what's happening in retail, I would say, hey, it's great that Walmart is catching up. I've always thought that they will be a good number 2 behind Amazon. We're seeing that with Target and others, and we're seeing other companies that still can't figure it out. Look at Rite Aid and Albertsons, a deal that totally fell apart that really should have gone through if it weren't for the percentages of what the controlling company would get versus the target. But that's what we look for. Okay, so we're always looking for those changes. So right now, when you take a look at retail, the one that I like, just given what I said earlier about the concern for consumer, is Costco. And Costco has been killing it. Whether it is, their monthly same-store sales reports, which have been, stellar, or you look at the fact that they're opening up more warehouse locations, and that's driving the all-important membership fee income. A lot of people don't realize this, but that membership fee income not only separates and insulates Costco compared to like a Target or a Bon-Ton or some of these other names, but it is a significant piece of its EPS generation. So it's kind of a win-win there for them. But if you think about what they do, they're helping consumers stretch their dollars. It's, why others like TJ Maxx and its portfolio have done, extremely well.
Now, it's interesting that you said a couple of things there, and let's take Costco for an example, because
Sure.
You're a chief investment officer, chief investment strategist, and I know you have a partner, Lenore, who's a great macro strategist, right? So when you're looking, you gave a lot of factors that you look at and changes, you said, and how to play that. Is there anything in particular? I mean, is there more factors that are more important than others? Because you're a junkie like me and look at everything, but there's just little things that I need to see that makes me look further. Like, for example, you look at Costco and you see a forward P of 31, and a lot of people would be like, wow, that's expensive, but there's a reason why it's trading at a premium, because they're growing. And just to be clear, guys, Apple was trading at 50, 60 times earnings 12, 13 years ago. Celgene, Netflix was 100 times earnings. Those stocks are up thousands of %. So is it growth? Is it top down? Is it just everything that you see? But talk a little bit about, which I like to get with my guests, is how did you pick Costco out of every single other retailer?
Well, one, it was that membership fee income. That was a real differentiator for them. In some respects, you could liken it to Amazon Prime, where people pay their money, once a year, and they have that great cash flow. But they're opening more warehouses, and that's the key to driving that membership fee income. But, some of the data points that I look at, which I think are pretty telling, it's one thing to go, oh, Costco's same-store sales were X. Okay, so you're tracking during the quarter, but that doesn't really tell you how they're doing relative to the rest of retail, right? I prefer companies that are growing faster than the market. I prefer companies that are growing their margin structure, faster than their peers, or at least the peer average. And when we dig into Costco, the great thing is not only do they give us same store sales, but every month we get the monthly retail sales report, and I can I can thumb all the way through and look at the line items that I need to see. And more often than not, over the last year, Costco has been killing it. So it's easy to kind of say, okay, I know they're winning. I know they're growing their profits faster because of that membership fee income. Now I have to wrap my head around the multiple. And, to be fair, Frank, I've had to boost my price target on Costco 1, 2, 3 times already this year, because they continue to outperform, and not just by a little bit, but by robust numbers.
Now, let's move into some other sectors and things, because I know that cannabis is always a topic that's on the fence. But listen, I mean, there's clear benefits. The science has definitely changed. You're seeing lots of states approve it recreationally. Tons of states, I want to say more than 35 of them, have it approved for medicinal. Not only is it good for the government where they're generating revenue on something that they can't stop anyway, that everyone's going to do. It just makes sense that more states would probably approve this. And there's a lot of companies that are finally starting to benefit. But also, as you know, Chris, there's a lot of crazy companies in this industry, people just trying to make, a buck because it's a hot industry. How do you separate real from fake? And is this an industry you cover? And, also throw in there, do you get negative feedback from clients sometimes covering a sector like this?
Well, to be fair, again, we're talking, one of the things that I look for is change. Okay. And, we can talk about the change in retail. We can talk about the change that Coke and Pepsi are going through, trying to put, sugary beverages and artificially sweetened beverages behind them towards healthier snacks and drinks, or at least snacks with Pepsi, mostly drinks with Coca-Cola. But you're talking, the way I look at it is what's going on in the tobacco industry, right? It's no secret that tobacco, continues to be what a lot of people call a sin stock, or what we call a guilty pleasure stock. And what are we seeing? We're seeing pack volumes decline, prices go higher. Great for investors because that's great for margins. And these companies tend to pay out dividend increases. Fantastic dividend increase, by the way, on Altria. That gives it a dividend yield easily north of 5%. And I think the stock will move up as a result. But when we start seeing companies like some of the alcohol companies dip into cannabis, that's when I start to get interested. In our podcast a couple of weeks back, we actually spoke with someone in the cannabis industry, and I asked the question that was percolating on my mind is, how long until big tobacco gets into cannabis? And to me, it legitimizes the industry. They have the marketing to the extent that they can do it. They have the manufacturing and the distribution to really move it national. And, the pushback was, they are probably going to. The issue is going to be, when is it legal in all 50 states? And there's no longer a federal issue. So to me on cannabis, I think it's extremely interesting. I think Altria just said the other day that they are eyeing the cannabis industry. So for me, it's kind of on the periphery, but it's one of those areas that I agree with you that once the cuffs come off, so to speak, I think it's going to be the stigma will be removed, and it'll be a growth industry for sure. I just think that some of the companies we're seeing today are going to get snapped up. And candidly, I can't believe I'm going to use this, Frank. I apologize. Deep in the weeds.
Love it.
I am not deep in the weeds with that. So for me, I'm just looking to play who benefits as a potential consolidator. And right now, I really like Altria, especially since there's some news out that e-cigarettes are going to take it pretty hard on the chin. And I think that's going to prop the big tobacco stocks up.
Makes sense. And you said something that's really important there, Chris, where the federal level, right? So marijuana's not approved on the federal level, meaning that you have most banks are not going to take payments, right? Even if it's legalized in the states, in Colorado, Oregon, wherever it's, Vegas, in Nevada, they're not, they could technically go there. And I mean, it's tough doing business when you're not approved on the federal level, because now you have a lot of cash payments. I mean, I hear things in Colorado with these trucks of money and whatever. Now let's switch to another industry, which is gambling, because now they just came out, right? I think it was in May, right? Supreme Court ruled that the states could basically license themselves, or they could offer gambling in every single state, and also sports betting, which is, a monster industry. Now, since there's change, and you probably look at things like this, especially because the Supreme Court or something could change an industry immediately. And if they make a change, it could be they could literally create $100 billion industry with a signature. Is this something that's on your radar? Because it seems like a lot of change there too.
So it has been, and in particular, one of the stocks that we owned was MGM Resorts. So we were looking at that, and then candidly, I think some of the numbers kind of turned over in Macau and Las Vegas. The monthly numbers that come out where they report on Nevada gaming also moved lower. And candidly, we were stopped out. And I've looked at this on the periphery, but where we're seeing, I think, the opportunity that we're focused in on, not that that's not an opportunity, is we're really trying to figure out where our clean living investing theme is going. And I say that because when you look at, Pepsi buying SodaStream, Coca-Cola snapping up a coffee company, you look at Coca-Cola bringing out a Dasani free machine where you can get water or bubbly water for free, but if you want flavors, you have to pay for that. We look at Cava Mezza Grill taking out Zoe's Kitchen. There is a huge push towards this healthier eating. And to me, the companies to watch in that, yes, there is Pepsi, there is Coke, there is General Mills, there is Kellogg. The other one, though, is Hershey, because they are a snacking company, right? But they've made a couple acquisitions. One was Crave Jerky, and then earlier this year, and I have to get a little careful. I'm not overly promotional, but they made a hero out of me when they bought Amplify Snacks, which is the company behind Skinny Pop. So it's watching these things from the periphery. And just to bring us back to an earlier question, these things, these changes, just like the one at Walmart we referenced, they tend to be, nip and tuck acquisitions, kind of slow. And as you know, Frank, once these transformations get past a certain point, they really start to whip. And when they do, there's a significant leverage that comes to the forefront. So, you asked me earlier of how do you deal with all the headlines and all the, hey, you got to buy this now. And what I try to do is, as best I can, kind of block that noise out and focus on what's, growing the business, changing the business, or decisions by other companies. Before we were taping, you were talking about the home run stock pick that Lenora shared with you, which is Universal Display, ticker symbol OLED. We were able to see that change happen, 18 months ago. We were first getting signs that Apple was going to finally move into OLED with the iPhone X. And, even before then, there was a lot of rumblings over what they were looking to do. But if you know some of the constraints on the phones, where traditional LCD backlit screens take more power, OLEDs are emissive, less power hog, there was a sense that they were going to go this way. So to me, the one change just on the mobile front, and I apologize for kind of dragging us all over the place like a dog with a toy, is 5G. And I think that's going to be one of the more interesting changes that we have coming up, changes the business models, and probably usher in the next big iPhone upgrade cycle.
Yeah, and I have to share a story with you really quick, because I realized a change in Coca-Cola early on, because when I was younger, I played basketball like crazy, and one of our friends decided to start a company just a while ago. And he said, hey, we need drivers for our company. I was like, come on, just play basketball. What are you doing? Get out of here. And, a couple of people took him up on that. That was a long time ago. The company he started was Vitamin Water, which he sold for $4.1 billion Coca-Cola. So micropoly, which really ticks me off. So you want your friends to succeed, but you don't want them to succeed that much. It's like it's a little bit too much, but good for him. But that to transfer, like the water companies. Yeah. You're seeing it at coffee. You gotta get it. I mean, it makes sense.
Water, coffee, tea. You're seeing huge pushback at Starbucks over those fattening, or high calorie, I should say fattening, frappuccinos. They are now pushing cold brew and some other, quote, skinnier beverages. Even Starbucks, of all places, is going to bring out their own line of kombucha. So there's a lot of change going on, which is, to me, it's interesting, because those are the opportunities, that you and I might talk about this stuff when we're paying attention to it. It's getting in ahead of the curve. So when the mainstream does start to talk about it, you're kind of well positioned for it.
And I want to ask you one more question before we get some of your stock picks, because you mentioned with Costco, and you said one of the things you love is, look, that they have that fee that you need to pay, and you see the transitions taking place. But it all matters about the stock price, right? Like OLED, the timing was absolutely perfect. That's a stock that really came down a ton before it really went up a lot. So, Costco was collecting these fees for almost, for forever. So what are the factors that you look at in terms of like the right timing for this? Because, you're in ground zero of information, right? You're on Wall Street. You have tons of contacts. You hear a lot of things. Just ideas coming across your plate all the time. The timing, how do you get the timing right where, OLED, it made sense even 6 months ago, but when Lenore, she came on and that pick was just, the timing was absolutely perfect. We know we can't, it's not, you can't get it exactly right, but is there something that you look at in terms of price when maybe something's factored in or maybe something's not, and here's the time to execute?
Yeah. So, well, let me try and answer this maybe a little differently than you asked it. One of the issues that I always see is people kind of valuing the company relatively short term. And by that, I mean, even now it's September, people are starting to look at what 2019 earnings might look like. And I recognize that with 2019, we've got, when you look at the S&P 500, you kind of have to figure out, okay, what's the economy growing at? We've got tax reform rolling off. There's the impact of buybacks and that other stuff. But when you look at companies, I like to go, 2019, 2020, and not that I'm expecting to nail the EPS for 2020, but I want to have a sense of what are the drivers that are going to allow the company to continue to grow, and can they achieve that? And then even then, I'll tend to haircut it back. But I think the other issue that people tend to do is they go, well, historically it's traded at a PE of X. And I think as well as I, Frank, that PE is an interesting valuation tool. It is certainly not the only valuation tool. And I think you need to know what tools to use, just like a good carpenter does, when you have a situation in front of you, right? Do I got to pull this nail out? Do I got to hammer this screw in? What do I have to do? And for certain companies, like a Coke, a Pepsi, a McCormick's, for example, or even Altria, as I mentioned earlier, these companies are dividend dynamo companies. So you can look at historical PE, where they peaked, where they troughed, but you can also look at, dividend yields, forward dividend yields, if you can kind of ballpark where you think they might increase their dividend to. Of course, you have to check the dividend payout ratio first to make sure you're not too high. But these are the type of things that we look at. Also, too, for some of these transformation companies, like a company formerly known as Taser, Axon Enterprises, which I think this will probably be my pick, but I think it's an interesting story because they're going from tasers to body cameras, but the real juice in the business is the cloud-based service that they have on the back end, evidence.com, that allows them to search and transfer all of that video, video evidence securely. To me, that's a subscription business model, so they tend to get higher multiples. So to me, I think that's an interesting business that says, wow, if they can grow this business, perhaps a better way to think about it is either a sum of the parts valuation, where you would look at components for Taser and who their peers are, and then you look at the cloud-based service business and who some of those peers are, and then kind of come up with your sum of the parts valuation. You could also do a PEG valuation. Just you got to be mindful that you need to know when the cloud-based business is really going to kick in, because currently it's a little bit of a drag on the overall profit line. Quite a bit there, huh, Frank?
No, that's great. That's great. Because I was gonna say, like, where are the places that you're seeing change in? What other places or some stocks?
Well,
and throughout the whole podcast, you gave us like tons of stocks. So
so Axon is one. I really like that. That's our. We just reconstituted our thematics. So we have 10 investment themes now, and that one is the one that we've selected to be what we're calling our thematic leader for that investment theme. And I think that is something, that stock will be one that, like any stocks, it can be, a little volatile in the short term. But I think if we're looking 12 to 18 months out, I think now is a great time to buy that stock. The other one that I'll mention, which I think, and this is a great example, and I think your listeners will gravitate to it, is Disney. And you might say, Disney, Chris, what do you mean? It's movies, it's theme parks. What are you talking about? And to me, and this is the if Disney can get their own streaming service up off the ground and garner subscribers, that is a sea change, not only in terms of how they deliver their video content, right? But it becomes, again, a subscription business model, a lot of cash flow, right? That means that you'll have to break Disney down again and revalue the company. That to me is interesting. Again, they haven't really, I think January is when they're going to start doing this. But when you look at their content library that's out there, it's pretty robust. And I think they're going to pull a bunch of content, like some of the Marvel movies, the Pixar movies from Netflix, and all the stuff going forward that they might have shared with them in the past will go onto their streaming channel or their streaming network. So I think that is something to watch. If that happens, I think the way people look at Disney entering 2019 could be very different by the end of 2019, most likely 2020.
Yeah, it's interesting you say Disney too, guys, because to talk to the audience here is when you look at that streaming service and you say, why would they take it off Netflix? Because they get huge fees for their content, and they have one of the biggest libraries out there next to Time Warner. But you bring up a good point, because there are cable companies that I saw that signed with Disney already for the streaming services, and Netflix is a direct competitor of the cable company. So now with a great library, right? Every content is king. You could have these guys actually bid for your content. So it's pretty smart the way Disney operates. And I'm an ESPN. You're a sports fan. I'm a sports fan. I'm not too crazy about what's going on there. You got to watch 30-second video to watch Steph Curry dribble through his legs for 10 seconds. But it's just the money generation, the money flowing in right now, and you see it reflect in the stock price. I mean, it's come back a lot, but it is an interesting pick. And I want to bring it. You said Disney, and you said something interesting, because you're like, I know it's Disney, because I recommended Amazon to my subscribers at around 900 a year ago, and people don't pay me to recommend Amazon. They can find on their own, but this is after me doing tons of research on every single cloud company. I mean, really digging in for months and saying no one's even in the ballpark, and no one's going to see more growth in this company. And this is incredible outside of everything else they have with, IoT and Alexa and, smart homes and stuff like that. But you brought up a good point by saying, but it's Disney, and I know. Is that a hard sell for your clients? Because sometimes when we have they want to come to us to find things that they can't really find, but sometimes the best plays are right in front of you, where Disney could generate 30% on a risk-adjusted basis. That's awesome. But yet it seems like some people are like, well, I could have got that on my own.
Yeah, I think what people want is either they want new ideas that they haven't uncovered before, like for a universal display, for example, maybe an Axon, things like that. But I also think that they want you to look at things with your particular strengths, your investment mosaics, and say, look, you own this. In the case of Disney, you should hold it, and here's why. Right. As far as Amazon goes, another one, right? Yes, it's very obvious, I think, to some folks that, we're going into the holiday shopping season. Amazon's going to be a beneficiary. Some people don't know that Amazon has AWS, which is, most likely the operating profit generator for the company that funds a lot of what they do. But there's other opportunities in there too. And to me, when it comes to Amazon, I mean, we've got a $22.50 price target on it. And I see them benefiting from continued cloud adoption. I see them continuing to, garner share in the retail market, because, at the end of the day, what I've summed up is Amazon's strength is removing friction from transactions. No matter what business you're in, they're excellent at it. But to me, what I get most excited about now is, no, it's not a potential federal win of size with the Pentagon for AWS. It's not the international expansion, although that could be very important longer term. To me, it's the pending acquisition of PillPack that gets them into online pharmacy. That is a game changer. And it's a huge opportunity for them. One of our investment themes is the aging population. You think about having your recurring prescriptions come to your door through the power of Prime, and it sticks with that with that notion, removing friction.
No, it definitely makes sense. That makes sense. Now, if somebody wants to learn more about you, they want to find you, your Twitter handle, things like that, how do you do that, Chris?
Yeah. So the easiest thing to do is Tematica Research. That's where we've got premium products, Lenore's Weekly Wrap. We've got our podcast there. As far as Twitter goes, it's @_ Chris Versace, and that's pretty much it, Frank.
And any TV appearances coming up? Because I know, you see a lot. You're out there a lot, and you're a modest guy, so feel free. You're a guy that doesn't promote himself, and those are the guys I actually love to promote because, you are out there a lot. So
well, I appreciate that. I mean, we do the podcast every week. Been doing a lot of cheddar with those guys. So usually when I'm in New York from the floor of the exchange, they're great. TD Ameritrade Network with Oliver Rennick, great strip, web stream show. You probably have some Fox Business coming up and some other stuff. But, the other one that I can tell you is every Monday and Thursday morning on the radio, I'm on with Matt Ray on America's First News.
Awesome. Look, you're a big shot now. I'm surprised you come on this podcast.
Stop.
I got to pay you, Chris.
Stop. No. It's, what I enjoy about these conversations is it's just that it's a great conversation. It's not like, sometimes when you do these, TV appearances, the question you get asked is oftentimes not the subject that's coming in. And the other nice thing about it is if I'm talking to you, I don't have to worry about if the president all of a sudden cuts us off and I got to sit there in studio for 40 minutes wondering, am I going to get on the air or not? So.
And it's a process to get. You have to get there an hour early. You got to wait.
Oh,
they have to put makeup on.
Oh, they need a ton of makeup on this face. Who are you kidding? The what I was going to say though is, it is true, and it's. I think it's one thing that people who are not on don't necessarily recognize, which is there is you might be on for, like, if you're doing pick a network, you might be on for 5 or 6 minutes, and the issue with that is just what you said. You've got to be in the chair 15 minutes beforehand. You got to get the makeup on. You got to be there early. And you got to get there. So, I mean, what some people might think of as a 5 or 6 minute video hit can take, depending on how far you got to go, 2 hours, 2.5 hours.
Yeah, no, it is a lot. And as well as I do too, sometimes like the questions do change. They'll give you, the list of topics, and some things they might be breaking news, and you're a guy that covers everything. So they'll ask you. That's why they probably love you as a guest. But it's 2 to 3 minutes sometimes, right? And a lot of anchors like talking more than their guests, which is why I love the podcast. I know why you love doing podcasts, because I actually get to listen to you for 20 minutes or I guess 20, 30 minutes. Their ideas, and you get to speak. And I think that's why these podcasts work. So I'm so glad that you guys have one up and running, and it's doing well.
Yeah, I appreciate it. To me, it's the notion of getting into a deep conversation where, you can go back and forth and, pull the skin off the onion, as it were. Whereas, 2, 3 minutes, 5, 6 minutes, you're not going to get that deep.
Absolutely. Absolutely. So, Chris, listen, thank you so much for taking the time. Again, you just talked about your busy schedule, and you take time to go on this podcast, share ideas, share your methodology of picking stocks. And I got a lot of great feedback last time you're on. I'm sure it's going to happen again. So thanks so much for coming on, bud.
You got it, my man. Thank you.
Okay, it's great stuff from Chris. I mean, good friend, guy that knows the markets, guy that's always going to share ideas with you. And he's humble, which I love, because he should be more arrogant. He's a really good analyst. And in all fairness with Lenore, I mean, Lenore's more the macro person, but they both, that stock pick comes from both of them. But of course, I'm going to tell him no, it came from Lenore 100% instead of 50-50. But it just shows you, the All-Star portfolio and what I'm trying to do for you guys. I mean, trying to find a really good price for that at allstarportfolio.com, where you can get, I'm going to choose one of those picks. I talked to Chris exactly which picks, he thinks are in buying range. And then, we'll throw that in the portfolio, and you're getting a list of picks outside of the ones that I just recommend. And sometimes it'll include shorts. It'll include, cryptocurrencies, just all over the place, different sectors. It's incredible. So right now, portfolio is doing really well. A lot of the stocks are taking off, and I'm glad, because that's why I created that portfolio, to have the best stock picks that some of these guys get paid $30,000, $40,000 for. And I'm not kidding, because some of these guys are hedge fund people that you're going to have at your fingertips for a real cheap price, and a lot to choose from. So Chris did a great job. Love him. Let me know what you thought, right? Podcast about you, not about me. Let me know, Frank@CurzioResearch.com. That's Frank@CurzioResearch.com. And let's move on to my educational segment. You know how I feel when it comes to the media. Okay, I'm just, they amplify stories, they promote, to put in perspective, guys, in the past, journalists reported the news as it happened. They would visit the sites in person, interview numerous sources, report the facts. Of course, it was always the most controversial stories move to the top of the page. I mean, if there's a murder, someone killing somebody, if that compared to, say, fourth graders starting their own charity, which story that they're going to publish. You're going to move up to the headlines, right, to the top of the page. But the reporting used to be fair and balanced. And today, there's not a major media company I could think of that doesn't have an agenda. You just try watching, Fox News or MSNBC. I'm not ragging on these things. But if you watch it for 30 minutes, you'll see exactly what I mean. And some media outlets are not even reporting the facts anymore. Right? They're promoting random events as trends, like an Ebola scare, or encouraging groups to hate each other, right? Democrats and Republicans, you can't be one of them without hating each other now, right? There's no compromise. And they're even presenting unreliable research in place of scientific evidence. So you look at things like the anti-vaccine movement. I mean, that was pretty crazy with Jenny McCarthy. Again, I don't want to get too political on this, but a lot of people didn't vaccinate their kids, and now you're seeing massive cases of measles pop up and stuff like that, all because of a report. A lot had to do with a report that was kind of false, right? That was retracted. And but look, that's a story. So let's promote this every place. And there's a lot of power when it comes to not just the media, but you're looking at shows like The View, if it's Oprah Winfrey, if you got to go on Larry King, which, again, Larry King's not there, but the vaccine thing, he was going crazy with that. Different talk shows, and you get celebrities behind you, like what we saw, with Al Gore, right? I mean, the world was supposed to end right now. Is climate change an issue? Of course it's an issue, but did you really have to scare the hell out of us and cite facts that aren't true, right? So you got to be careful when it comes to the media, and I'm not ragging on them. What I'm saying is you want to use it to your advantage, because if you're smart and you understand how the media works, it can help you generate huge profits, right? And for example, how many stories do we read about, market crash was imminent, right? And this is since the credit crisis. The U.S. dollar was going to crash, ATMs are going to run out of cash, and people are going to riot in the streets, right? And we have stocks at all-time highs. The S&P 500 is up over 300% since 2009 lows. So if you just ignored everything and the noise, you'd be doing just fine. I brought up with Chris, late 2017, how big box retailers were, it was supposed to be over for them. They were dead. I mean, if you go back and read the headlines, it's incredible. Now everyone's buying retailers and department stores. I think it's great. One of the best performing sectors out there. So ignoring a lot of this stuff or reading it, look, it's easy to get lost in it, right? That's why I was pissed off at the beginning when they were reporting about nuclear plants. Guys, it's a story already, right? I mean, you have a major hurricane, 104 miles, one of the biggest that are going to slam into the coast. It's going to be really ugly, and you're reporting about nuclear plants. Like, come on. So you want to try to use that to your advantage. And you do that by doing the research, by uncovering what's real and what's not real, because a lot of times stocks get hit because the media is all over them. And there's a lot of stuff that they'll amplify. They'll say all this crazy stuff. I mean, you had a chance to buy Facebook, at 160, 150 when it came down from the testimonies from Zuckerberg. I know a lot of you hate Facebook, get emails all the time. I'm talking about the stock pick, right? My job is to give you stock picks, just like Chris just gave you Philip Morris, right? My dad passed away from cancer. It's not personal. My job is to give you great stock picks, right? So Philip Morris, great dividend. You did great over the past 15 years. Now, my point is, there's another sector that the media is really, really not destroying, but just publishing false data on. And it happens to be the cable industry. Now, I'm putting my personal feelings aside. You know how I feel about Comcast, right? And if you owe them $10, I have 15 people call you 10 times a week. But if you need something done, you have to go to an automated system forever, right? They could do that because they basically have a monopoly. You might say, well, AT&T with fiber, they're rolling out fiber. Well, it's not as fast as cable. It's not as good. It's still early. You have Fios and Verizon. Yes, that's rolling out. But, no matter what you want to do in streaming, you need the internet connection. And that's where the cable companies have that cable going directly to your house. And people say, well, cord cutting is going to crush the industry. It's going to destroy it. And it's funny when you hear that, because when you look at the statistics, that's really not the case. So if you look at cord cutting, right, it's basically a term used to describe people who are canceling their cable TV services. Instead, they're going to watch favorite movies, television shows, everything else via the internet, which is streaming. So if you go into Google right now, go cord cut, you can see 300 million results. And a lot of these stories highlight how cable companies are at risk of losing tens of millions of paid subscribers every year, which is going to crush them. Now, if you look at the industry and the pay TV, right? So it's pay TV losses, and you look since 2013, 2017, 2.9 million people cut their cord. 2.9 million people. Now, some articles are going to highlight how cord cutting is up close to 90% over the past year, and they're right. Because from 2016, there was about 800,000 that cut the cord. And 2017, last year, right, is 1.5. So you have 1.5 million that dropped off due to cord cutting. So the articles are highlighting how it's up close to 90%, a huge percentage. Other articles are going to cite how cord cutting accelerated as the pay TV industry, which is, cable, telecom, satellite providers, they saw record subscriber losses. These statements are actually true. But you have to look under the hood a little bit, because when you look at the actual data, It suggests cord cutting, and, it is a worry, is not a disrupting trend that is going to lead to the death of cable companies. For example, the data shows 2.9 million households no longer pay for TV, and this is since 2013, from 2013 to 2017, right? 2.9 million, which is right. So this includes people who canceled their service or never subscribed again after moving into a new home over the past 5 years. However, there are still 96 million households that pay for TV in America. 96 million. And when we take the 2.9, it amounts to a 3% decline overall in 5 years. Is it a decline? Yes. Is it disruptive? No way. It's not disruptive. You say, well, but if you read the stories, you would think otherwise. Right now, you're probably saying, Frank, come on, it is disruptive because of the stories. I'm looking at the data. So another overlooked fact about cord cutting is when you look at the statistic, and there's one particular called the average revenue per user, ARPU, very important metric for subscribers, and anything that has subscribers, average revenue per user. This basically, it's the average price subscribers are paying every month, and specifically this case is for cable. Now, the average revenue per user, okay, now when subscribers are going down, has consistently trended higher for the past 10 years. So they're able to charge more money. Why? Because they're offering faster internet speeds, and you really don't have a lot of options. Some places you might be able to choose your cable company or Verizon, or maybe AT&T. I chose AT&T in my neighborhood, and they promised me speeds that are definitely not the speeds that they promised. If I had to do it again, I would have kept Comcast, even though I don't like them. I know they have a monopoly, but you have to use them. And Comcast, you could say anything you want. You can get as mad as you want, Charter. You have to use them unless you don't want to go on the internet. I have to use them for my business services to broadcast this podcast. You have to use them. So the fact that their speeds are getting even greater and they're improving their speeds, they're charging more money. And yeah, they'll throw you in the bundle no matter what and say, well, internet is $50 billion a year. But if you get the bundle, which includes, phone, internet, and TV, we'll charge you $135 a month or something like that. So you have to get the bundle this way. Again, the cable company's going to pad their stats and show that, wire television, phone lines are still growing when, everyone kind of uses their cell phone these days, and not too many people have that direct connection. And remember the dial phones? I had a friend actually put that on Facebook, and her daughter was like trying to use the phone that you dial, and she had no idea what it was or how to use it. It didn't seem that long ago, but I guess it was. But anyway, getting back to the point here, this explains why, if you're looking at cable companies, right? So the average revenue per user was $89 a month in 2015. This rose to $92 in 2016. It's $94 in 2017. And so far, the 6 months of 2018, it's up again. So it actually explains why cable companies, while losing a small percentage of subscribers due to cord cutting, continue to report very, very strong profits year after year. But their stocks, and if you look at them, have gotten hit. You can say, well, you look at Charter or you look at Comcast. I mean, Comcast is still it's trading at 12 times earnings. Charter Communication is trading at a little bit higher valuation, but you have to remember these guys are generating so much free cash flow. And when you look at cable companies, you look at cord cutting and say, oh, and you look at their debt and you say, oh, but you have to look at their debt as well, because they might have tens of billions of dollars in debt, but you want to see when it's due. And a lot of that debt is not due for the next 5-6 years, maybe 20% of it. And that's easily covered by the free cash flow they're generating, right? That's why, what are they doing with this free cash flow? And it's getting bigger and bigger because they're charging higher and higher prices, because we don't have a choice, because they have pricing power, right? A very big point when it comes to stocks. If companies have pricing power, that's huge. If they don't, you're going to see profits and margins always go lower and lower and lower. That's why AT&T is getting out of the wireless business, which is smart. And Verizon is kind of late to the party. So whether you like what AT&T is doing or not, the choice is stay wireless, get 90% plus revenues from them, and then you have to deal with everyone, these free plans. You get phones for free. You get all this data, from Sprint or T-Mobile or Straight Path or whatever. Now they're getting more into the content industry, the advertising industry. And taking over DirecTV, Time Warner. So now AT&T comes into every single home in one way or another, right? Either you have their services through internet, DirecTV, or if you watch HBO or something. So now they have distribution, and now you have they're combining that with one of the biggest content providers in the world, which is Time Warner, throw in advertising, and you can see why AT&T is exciting. Is it going to be difficult, this transition? Absolutely. They're changing their business model. So AT&T is probably going to get hit. They're going to report. But the fact that you think Facebook at 35.40, it took them a while to figure it out. I said the same thing. I told you to buy Facebook at 40 again. I've talked about my losers in the past. And I said, someone's going to figure it out. They're going to figure out because they have billions of people on their platform, which is amazing, on one platform. They'll find a way to monetize. I said the same thing about Twitter when I was at 16, 17. Somebody will find a way. Remember, they called for Jack Dorsey's head. He's terrible. He's horrible. Look where Twitter is. Look where Square is. Yeah, he's really horrible. That guy doesn't know what he's doing. How many people called for his head? They figured out Twitter. AT&T will figure it out. It could take longer than expected. I hope they get rid of their dividend because they're a growth company. They're going to be a Google. They're going to be a Facebook. They're going to be an Amazon. That's what they're looking to do instead of being a Verizon, which is just focusing on a market that's extremely competitive. And again, we're talking about domestic, right? So do you know anyone that doesn't own a phone that's over 16 years old? So how many more? It's all pricing. They don't have pricing power. Cable companies do have pricing power. Not only that, they saw the streaming risk coming. Just like if you look at pharmaceuticals with the patent cliff, they saw it coming, right? They knew that their drugs are going to come off patent. I read a stat the other day, which is crazy. Like 80% or more of the drugs are approved are basically forms of an existing drug. It's not even like a new thing, right? So they're combining whatever, Lipitor with something else. This way, you can combine it, shows better results, and you get another patent on it. So it's nothing that's revolutionary. They need to generate profits. But good for them from an investment point of view because they saw the risk coming. They invested small money in biotech. They started increasing their dividends. And look where Merck is, right? What happened to the patent cliff? Look at defense companies. Sequester, cut back at defense. They see it coming. They know what divisions are going to get cut, and they move in divisions like drones and services. They're going to see the most revenue. Defense companies, man, look at those things. I thought they were in trouble. Same with cord cutting, guys. You want to look at these stories and look under the hood. 3-4% decline in the entire industry over the past 5 years does not sound like a disruptive trend, but if you read the media, that's what you're going to see. And it's giving you a good opportunity to buy some of these cable companies, which are trading at cheap valuations and going to generate massive amounts of cash flow, which means what? They're going to buy the crap out of their stock. They're going to start lowering their debt, and they're going to issue special dividends, which a couple of them are doing. Does it sound familiar? Because it sounds like the airline industry to me. Remember the airline industry and Buffett saying, oh, it's horrible. Once they got their business model on track and realized that, hey, we're a necessity. People need us. We're a monopoly. Nobody could go into Atlanta and create a new airport, a new runway, a new terminal. So these guys have pricing power. And what happened to this industry? Now they generated so much money. Their debt levels are lower than ever. The stock prices are rising, and they're still dirt cheap. So it's an industry I haven't really focused on. Again, especially me, putting my personal feelings aside, cable companies, good investment, pricing power, going to generate tons of cash flow. And also, getting back to my point of how they're adjusting, they create their own streaming services. So if you look at them, they see the risk coming and all this cord cutting nonsense. Guys, just go in and dig in. That's how you make money. Because you have stories that you looked at push stocks lower just because it's so easy to change people's minds these days. It's so easy to condition people. If you're watching a certain channel, you're going to get their opinion. You're going to hear only what they have to say, and they know it. And I'm going to tell you something. These guys write a certain way to keep your attention. They have headlines written a certain way to keep your attention and make sure you click. It's a formula. It's a system. They know how your brain operates. They know what you're going to be excited about. They have all these statistics. They have all the data. They have all the algorithms. They know what you're going to think before you think it. So they're able to control your thinking, but try to take a step back and say, you know what? Let me look at the numbers and see what's really going on. And if you did, you had a great opportunity to buy oil stocks in a year ago, like 2017, when they said oil prices are going down to 10, oil supply, right? Supply issues, China's coming offline. Yet, they didn't talk about our growing economy. They didn't talk about that no producer can really make money with oil under $4 a barrel. And yes, there's certain wells that perform in the Permian and the 4 counties. I visited them, but most of them can't. So tons of supply was coming off the market under 40. And what happened? So prices come down, and prices have no place else to go up, right? So now you have our economy growing really fast. You have limited supply. I mean, it's just a recipe for prices to go higher, and look where they are now. And same with retail, same with defense, same with pharmaceuticals, and you know what? Same with cable companies. So, guys, if you're a subscriber to Curzio Research Advisory, I just recommended a cable company that I would say 90% of the people never heard of. And there's reasons for that. I won't bring it up because I'm not going to give it away. But it's a lot cheaper than Charter and Comcast. Actually, it's about a 20 to 25% discount to the industry. It's a company that if you look at the fundamentals, it looks expensive. If you look at the debt, you'd say I'm crazy. But people do not understand the story, which I explain. And people are going to understand the story probably next year, just like they understood with Venom, which is Viper Energy, which we bought, I want to say 17, 18, and 120% gains on it over the past probably 17, 18 months or whatever. Right? Nobody understood. Now everybody's recommending the stock like crazy. We're going to see the same thing, I believe, with this cable company that I just recommended. And that issue is going to be available to Curzio Research Advisory members today. And hopefully when you're reading this, it should be in your email. So, guys, a lot to cover there. Great interview. And I always say this podcast is about you, not about me. So let me know what you thought at frankcurzioresearch.com. That's frank at curzioresearch.com. And guys, that's it for me. Thanks so much for listening. Guys, be safe, please, from Florence. Be very, very safe. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.